Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Shauna Smith. Let's get you up to speed on the market action. We've got 1 hour left to go in the trading day, and the Dow is up 179 points. We've got the S&P 500 up 25 and the Nasdaq up 122. In terms of sectors we're watching today, consumer discretionary, one of the biggest winners on the day. Tech also seeing some big gains there with Amazon, one of those big names. So we are starting with markets reacting to econ data released this morning as jobless claims for last week rose by 28,000 to 261,000. That is the highest level since October 2021. As the labor market continues to trend in the right direction and stocks remain resilient, our first guest is raising his S&P 500 year-end price target. Let's bring in Brian Belsky, BMO Capital Markets Chief Investment Strategist, joining us here in studio.
Oh, Akiko. Yahoo.
Good to have you here in studio. Let's start with that target. We're raising your target from 4,300 to 4,550.
Yep. So we had three scenarios coming into this year, okay? A base case, a bull case, and a bear case. And so our base case was 4,300, our bull case was 4,800, and our bear case was 3,600, okay? So we raised our price targets by 250 points across the board because the cost of equity is down, equity risk premium down, inflation down. So we believe the worst case scenario in terms of the Fed and inflation has already played out. Or has not played out, I'm sorry. So therefore we have to adjust accordingly. That's number one. Number two, we're not changing anything on our earnings number because we think most investors are looking to 2024 anyway, and nobody really knows what 2024 earnings are going to be like. But we've seen a massive, you used the term resilience before, we've seen massive amounts of resilience in corporate earnings so far this year. So we think our 220 number's pretty good. But we do actually see earnings accelerating in the fourth quarter and then into next year. But we'll get to that while we get to that. Now, the next question you're going to ask is, so, well, at 45.50 and 220, that's a 20 multiple, Brian. Isn't that expensive? Well, if you go back and look at history, and it's something that we warn people coming out of a bear market, the average multiple increase for 12 months following a bear market is 6 multiple points. 6 multiple points. So multiples go up, okay, because earnings are low, multiples, and stocks lead earnings, which lead the economy. And that's exactly what we're seeing. And so we still believe that we're in a big, giant 20 to 25 year bull market. We're not being stubborn. We've been accused of that because you can have negative in flat years, like we had a negative year last year, and we were wrong, and humbly, we lost people money, but we've been right 9 out of the last 10 years. And remember, 7 out of 10 years, markets are positive. So we'll take that math. But I do believe that the worst is behind us. The Fed maybe has one more interest rate increase between now and the end of the year, and that's okay, but I think most of that has been already priced into the market.
Brian, where does the Fed stand in its fight against inflation right now? Because you make a point in your note that inflation, we are seeing some positive momentum in terms of it easing right now, but we're still at pretty high levels compared to where the Fed would like it to be.
Well, BMO has learned. BMO has learned that we're going to have higher interest rates for longer. Anything is higher than zero. That's number one, okay? Number two, in terms of the 2% target that the Fed is targeting with respect to inflation, we still need to have some work to get there. And Canada rose interest rates yesterday by 25 basis points because we've seen some more higher food inflation there. So are we going to have a little bit higher inflation this time around next week when we see CPI, PPI? I don't know. I do think the Fed probably has one more 25 basis point. For us, the way we look at things, it'd almost be better, Shauna and Akiko, if they raised interest rates by 25 basis points one more time, because I think it would be a lot worse for the market to pause and then later this year all of a sudden they come back and go, inflation's coming back, because then you have the rhetoric with respect to, this is the 70s again and the Fed is wrong, and then I think that would really cause a stir in the market.
So get the hike out of the way next week.
I think so. And I do think that the bond market's kind of telling you that. I think the high is in for the 10-year Treasury, which is good news because that'll be good for mortgage rates. But I think people are missing that the home building stocks have been outperforming. And home building stocks have been outperforming. That's a leading indicator for the stickier part of inflation, which is the services side, meaning rentals and housing and things like that. So if we had more supply on that, I think that's going to be really good.
What about the odds of a recession, the odds of a soft landing at this point? It sounds like maybe that is still in the cards.
soft landing, no landing, obsession, recession. We're obsessed with it. We're going through all the hits. You are an obsession if you like the 80s music. Listen, the stock market was down 27% peak to trough, right? And so the stock market, when it's down more than 20%, tells you that portends to a recession down the road. So it almost doesn't matter. I don't know if you know this or not, but you don't invest in the economy, you invest in the stock market. So the stock market's already said, hey, we're going to have some sort of recession. Mm-hmm. My bet is this. I bet within the next 12 to 18 months, the ECRI or those smart people in the economic world would come out and say, hey, by the way, we had a recession and it was in the third and fourth quarter of 2022.
Liking all these impersonations. This is an impersonation.
This is just for all the serious. So, but no, I'm sorry. I don't mean to be flippant about it, but I think we're worried about the end game versus living our life, right? Mm-hmm. So stocks lead earnings, which lead the economy. The earnings have held in a lot better than everybody thinks. The economy is still strong. I mean, you think about, go back 2 weekends ago, Disney had its 5th highest opening ever on a weekend, right? For Little Mermaid. We're still going to the movie theater. We're still spending money. I'm jumping on a plane this afternoon. There's no seats. There's no hotel rooms. It's not just in New York City, but it's everywhere. So people are still spending money. They may be not spending $150 at Lulu, but they're still spending $100. And that's a good thing.
Let's talk about your investment thesis and what you're liking right now. The tech sector, clearly seeing some of the big gains here, up more than 30% on the year. You are overweight on the sector. Is it all about AI?
No, it's not. And thanks for bringing that up. And by the way, it's the first time we've been overweight since 2019. Mm-hmm. And that's a big call for us because at that point, heading into the end of 2019 into 2020, tech was about 30% of the market, and I don't like when a sector is 30% of the market. That's why our weighting's 29. That's number one. Number two, we've had three different tech markets so far this year. January was the January effect rally, meaning the worst performing stocks in 2022 were the best performing stocks in January. January and February, we had more of a value move. Then we had the bank, quote unquote, debacle. I'm not going to call it a crisis because it wasn't a crisis, okay? And you had investors sell their financials and buy tech. That's tech move number two. Tech move number three, I think, is the real move, and that is AI. I think AI is here to stay. It's built in efficiencies. I think you need to look at AI like you would any other emerging technology in another sector. For instance, in healthcare, you want to buy the big healthcare companies because they'll end up buying or finding the drug or the biotech that's actually going to work, right? Or in energy, you want to buy alternative energy. You want focus on alternative energy. Buy Chevron and Exxon because they're going to be the ones that are going to invest the most in alternative energy. It always works that way. So what does that mean for tech? I think it's Apple, Microsoft, the Google machine, Netflix. Those types of names. But also, we've owned core positions in NVIDIA and AMD because they're the best companies in that space anyway. So I think you want to barbell semiconductors. On this side, you have NVIDIA and AMD. And on this side, you have Broadcom and Qualcomm. You kind of balance out the higher multiple with the lower multiple.
It's putting to rest some of the fears out there that maybe this rally that we have seen in AI is overdone at this point. Brian, what about healthcare? Because you also changed your positioning there, your outlook for that sector, downgrading it to market.
Yeah, there's been a bit of thanks for bringing it up. There's been a bit of a COVID hangover, I'll call it. And we always like healthcare. We buy companies that keep us alive. That's kind of our thesis. Aside from United Healthcare. It's true.
I like that. It's a good investment.
United Healthcare is an amazing company throwing off lots of cash and great dividends. It's been one of our core positions for 11 years that we've been managing money at BMO. But I think some of these healthcare stocks get above their skis a little bit, and they've had a little bit of problems with growth. So we like the biotech sector for cash, actually, and value. There's some really great value there. And some of the drug companies, and a company like Thermo Fisher was just a juggernaut in terms of instrumentation. So we've just tightened up our positions there a little bit. Remember, people forget that healthcare is the second largest sector in the United States. Second largest. So you have to be really careful in there. I think you have to be much more stock picking. I think the other big thing that people are missing in the market, Sean, if I have a second, is small cap, small mid cap. I think we've had a generational opportunity to buy small cap thanks to the banking debacle. I think they threw the baby out with the bathwater with respect to small caps, and they've created this great and amazing buying opportunity. As the market broadens out, small caps with respect to cash flow, balance sheets, and earnings discernibility are the best I've seen in 30 years. And I think that's very, very good for the United States market.
So get in now.
Get in now.
Okay. Brian Belsky, BMO Capital Markets Chief Investment Strategist. Have a safe flight back.
Thank you.
I hope it's not too crowded.
It will be. That's okay.
Got to come back and visit us soon there, Brian. All right, let's talk about a big mover today, and that is GameStop. Its shares are taking a toll after the company shakes up its C-suite. The video game retailer fired its CEO and named board chairman Ryan Cohen as executive chairman. However, while Cohen is known for his king status in the meme stock community, the news of his new role at GameStop is raising some eyebrows. One social media user saying, quote, "Oh, RC is the CEO now? That same guy who rigged all those BBBY shareholders? Great." Followed by another user criticizing Cohen, who's a founder of Chewy, on his time with the pet retailer, saying, quote, "The same guy that could never make Chewy profitable." Well, GameStop's CEO switch also coming shortly before the company reported another lackluster quarter. And according to our next guest, this is part of the, quote, "the long and winding road to termination for GameStop." Joining us now, we want to bring in Nick McKay, Vice President of Equity Research at Wedbush Securities. Nick, it's good to see you here. So it doesn't seem like from your note that you think Cohen is going to right the ship at GameStop. So what's ahead here for the company?
Thanks for having me. Yeah, there are things happening at the industry level which are just going to be difficult, if not impossible, to overcome. So if you think about GameStop at a high level, it's hardware, software, and collectibles. And on the software side, you saw the number underperform in the first quarter. There are dollars increasingly shifting over to digital spending, mobile spending, subscription spending. All three of those things aren't really in a big way at GameStop. On the hardware side, eventually you're going to have this current generation slow down, and we don't have a date yet or even a name for a successor for the Switch from Nintendo. And then finally on the collectible side, Q1 underperformed, didn't really get a reason for that. But generally, there are things going on at industry level that I think Ryan Cohen's going to struggle to overcome.
Yeah, and Nick, all those concerns have been raised before, but I'm curious about the stock move that we've seen since yesterday, the announcement that we got. I mean, is this about Ryan Cohen? Is that why we're seeing so much pressure? Is this actually trading on fundamentals, a stock that doesn't normally do that?
Yeah, I mean, what happened yesterday between the shakeup at the top and the financial results of the company just highlighted to us instability. So you have, I think for the first time, at least that I've been at Wedbush Securities, you have a general manager calling the shots at GameStop as long as those don't go against what Ryan Cohen wants. You have a Q1 where sales missed by $100 million roughly, where EPS missed the street's expectations by a few pennies. Where you also saw a over $400 million swing in free cash flow to a burn of over $100 million. And we still, against that backdrop, we still don't really have a fully fleshed out turnaround program from Ryan Cohen or from the company in general. This time last year, it was going to be a push towards e-commerce. That didn't really work out. So reportedly, Mr. Cohen pivoted back towards in-store dynamics, and that hasn't helped. So I think what you saw in the reaction today was, coming out of Q4, the shares were up a lot on a big free cash flow number on results that largely meshed with what the industry had suggested in terms of its own performance. You flip that to Q1, you've got a big reversion to negative free cash flow. And you also have GameStop sales down 10% when the broader market's down about 1%.
Nick, to that point there, just in terms of the position that GameStop is in, the difficult path forward for them, what about just attracting top talent, bringing in great names that would potentially be able to help out GameStop in the future? When you have someone that's very divisive like Ryan Cohen, who people have very strong opinions about, how does that complicate that path forward?
Yeah, I think even if you brought in big names, you still would have the issue on the software side where dollars are going towards digital, mobile, and subscription, where eventually they'll go towards streaming as well. So I don't think a big name can solve that. And then on the hardware side, the numbers coming from Sony have been positive for the PlayStation. Microsoft had a rough quarter. Its hardware revenue is down roughly 30%. And Nintendo's been talking about softening Switch demand at retail for a couple quarters now. So I'm not really sure what big names, what they could really do to turn things around. And on top of that, you've got the CEO gone after about 2 years. You had the CFO leave after about a year. 1 year ago. I'm not sure big names necessarily would feel like they'd have an extended run at GameStop, given what's been going on at the executive level over the past 2 or 3 years.
So, Nick, you pretty much bottom line it in your note. You say you're convinced that GameStop is doomed. What does that mean? Where does the company go? Is it a target for acquisition? Is it headed towards potential? I mean, what are we talking about when you say it's doomed?
Well, they've got about 1.3 billion in net cash. This quarter, again, a free cash flow burn of just over $100 million. So, I mean, they should be in a position where they can last for several more years. But long term, in our opinion, it's not a story that can be turned around to the joy of the GameStop fanboys. So over time, the software piece is going to be challenged. The hardware piece is eventually going to be challenged by slowing current gen sales and by potentially Microsoft and others pushing gaming away from consoles and towards streaming solutions. And the collectible side, as I mentioned, just wasn't there in the first quarter. So they can hang on for several quarters, if not several years. But especially with the NFT marketplace not working out the way they'd hoped, I'm not sure what the solution is for these guys.
Yeah, and Nick, it feels like you're kind of tiptoeing around it, but you're talking about closure, right? I mean, bankruptcy. I mean, what is the end game?
I don't see why GameStop would be relevant within its core video game market several years from now. So, I'm sure there are some assets they can sell, but I think over time they're going to find themselves headed towards bankruptcy.
All right, well, GameStop shares off just about 17% in the final hour of trading. Nick McKay of Wedbush Securities, thanks.
Thanks for having me.
We are just getting started here on Yahoo Finance Live. Coming up, smoke from the Canadian wildfires impacting air quality for millions of Americans. We'll speak with the White House and National Climate Advisor on the other side. Plus, mortgage rates ticking down. We've got you covered on the latest in the world of real estate. And Snoop Cereal, the latest venture from rapper and entrepreneur Master P. He will join us later in the hour to discuss that venture, what's ahead, and what else he has brewing with his newest entrepreneurship dealings. We got all that for you coming up on the other side.
The toxic haze that enveloped New York has now clouded much of Philadelphia, grounding hundreds of flights today and postponing Major League Baseball games there. The smoke coming from Canada, where roughly 400 wildfires have put the country on track for its worst fire season in history. I spoke to White House National Climate Advisor Ali Zaidi about the impact of climate change and asked him how quickly he thinks the air quality is likely to improve. Take a listen.
Look, we're seeing the effects of these wildfires that are burning in Canada really impact the entire eastern seaboard above the mid-Atlantic. And the way we look at it, this will probably persist for several days. The unfortunate reality is that this is becoming more and more frequent in our cities and communities all across the country as a result of the changing climate. And this is something folks out west have become accustomed to, and folks out east are now experiencing anew.
And to that point, there's certainly a lot of people out in California that were looking at the images here saying, well, this looks eerily familiar with what I've experienced. Those other major cities outside of the U.S. who have had to deal with this as well. Can you talk about the impact from climate change and how much of that, what we saw yesterday, can we peg to the warming temperatures?
You know, what we've seen as a result of climate change is increasingly severe and frequent droughts. The West is in conditions that are really unprecedented, and we're seeing that in Canada as well. We're seeing heat waves ravage the country. Puerto Rico seeing that right now, but that interacts in a very bad way with drought and a lack of precipitation. And these things combine to really fuel wildfires, which have become increasingly frequent and severe across the West and in parts of Canada over the last several decades. We know there is science that tells us that this warming, these drought and heat events, that the increasing spread of wildfires relate back to things that we are doing to the environment. Putting carbon pollution in the sky has consequences, and we are living those now.
In many ways, if this is kind of the new norm we're having to deal with, cities from New York to Philadelphia are learning the business disruptions that are likely to come along with it. We saw flights that were grounded yesterday, sporting events canceled as well. Can you talk to me about that kind of impact that we're likely to see if this is going to become more and more frequent?
Yeah, folks often talk about climate change as if it's an environmental issue and an environmental issue alone. It intersects with every aspect of our life. It is a public health issue. Folks see that right now as they put masks on. But it is also an economic issue that can cost in the trillions of dollars. We've seen climate change disrupt supply chains. We've seen climate change hike up the costs of consumer goods. And we know that the only way to resolve ourselves is to resolve ourselves to shift as quickly as we can to clean energy and to invest, as the President Biden has, in resilience and adaptation to the impacts of climate change that we've already unlocked. But you're absolutely right. This is a supply chain risk. It is a material business risk, and smart money is chasing solutions, not, putting its head in the sand.
Where do you see the role of the White House? I mean, so much of what we are seeing right now, to your point, is on a very localized level. We know officials in these major cities yesterday scrambling to make sure those that were living there were safe, but also that businesses were operating normally as well. What do you see as a role on the federal level?
So in dealing with the issues that we have right in front of us, the president has been briefed on this. We've deployed human capital and water bombers, other aerial assets to support the Canadians. We've activated our National Interagency Fire Center to support response on the fire side. We're also deploying our EPA. Folks can go to airnow.gov to get real-time data using the air monitoring system that we've helped build out under the Biden-Harris administration. Our CDC is activated to support state and local officials with whom we've also been in touch with here from the White House. So there is a response aspect of this that's playing out in real time. And the president and the vice president have been animating that with a sense of urgency. And then, of course, the big thing that we can do is tackle the climate crisis, which is why that has been a fundamental pillar, an element of this administration's leadership. We've invested the most in clean energy and climate anywhere in history ever under President Biden. That's the root cause, and we got to get after that.
You talk about this being more than just an environmental story. Obviously, there is a huge economic impact. We have seen that play out really on a personal level over in California, where most recently we heard two major insurance companies, Allstate as well as State Farm, essentially pulling out of new coverage. It's simply too expensive for these insurance companies to try and insure homeowners who are in very vulnerable areas. There is the argument, of course, about whether, in fact, they should continue to be building there as well. But from a homeowner perspective, this has got to get a lot more costly, and they can't find insurance as well. I mean, talk to me about how you're looking at that from the DC perspective and how the White House is working with local officials to try and mitigate this.
Well, number one, we know that there are ways to both boost the efficiency and resilience of homes. There are fire-wise building code standards. There are water smart building code standards. And one of the things we're working on with state and local officials all across the country, and this has been capitalized by the bipartisan infrastructure law, is an effort to boost the codes with which we build new homes. So we're putting less strain on the system, and we're de-risking these built environment assets. That's going to be an important thing that we do. The second is making sure we're funding the retrofits to existing building stock, whether it's on the private side, thanks to tax credits included in the Inflation Reduction Act, like the Section 179D tax credit, which helps boost an energy efficiency of commercial buildings, or it's the direct grants that we're making through the infrastructure law that build resilience into our communities. We've got to rehabilitate our existing infrastructure and assets to harden it to this new reality. And then we've got to make sure that the market is helping foment solutions as part of this as well. That's why, in May of his first year in office, the president signed an executive order on climate-related financial risk. In that, he directed his Treasury Department and regulators to take a look and start to do the analysis underpinning how we better understand the physical impacts of a changing climate on the financial markets and our ability to ensure and make sure that we're propelling the private sector to come up with solutions. There are solutions in the space. We've got insurers, for example, in Florida that for over a decade have been helping finance retrofits to adapt homes to hurricane risk. You get a premium discount if you make the investment to bolt and brace your roof. So there are innovative solutions in the space. We need the market to chase after that. We need the regulatory infrastructure to promote that. What we don't need is a bunch of folks pretending like the problem doesn't exist or denying its impact on our economy and our way of life.
And our thanks there to White House National Climate Advisor Ali Zaidi. Well, coming up, Meta is rolling out its latest feature for WhatsApp. More details on the instant messaging app when Yahoo Finance returns.
Curious about what's going on in the housing market and whether or not it's a good time to buy this home or another one? We've got you covered. We've got a jam-packed week filled with experts, including real estate agents from across the country. We'll also get a temperature check on the state of home building and whether or not it's a good time to stack up on those home builder stocks. We've heard from home builders that they're capitalizing on the housing shortage. We'll also tap into commercial real estate. Is it doom and gloom after all? And can't forget, we'll hear from the real estate queen herself, Barbara Corcoran. Tune into Yahoo Finance Live all week long.
Well, Facebook parent company Meta is rolling out a broadcast-based messaging feature to be used on its WhatsApp. It's called Channels and is set to be updated into the app starting in Singapore and Colombia. Here to break down the new feature is Yahoo Finance's Dan Hallett. You know, Dan, we don't talk a lot about changes within WhatsApp too much. How would this exactly work?
Yeah, so this is called WhatsApp Channels, and essentially what it's going to be is, you know, as kind of said, a way to broadcast to groups that want to follow certain entities. So whether that's, you know, Yahoo Finance could have one, your local city could have one. It's basically a kind of a one direction kind of way of a organization or a group communicating with others. So we actually have a statement from Mark Zuckerberg about it. He says, today we're announcing WhatsApp Channels, a private way to follow people and organizations that matter to you right within WhatsApp. I just wanted to throw that out there. He said, we're starting in Singapore and Colombia, but we'll roll out to everyone later this year. He said it's the most private way to communicate. The thing here is it's not going to be end-to-end encrypted. So that's, you know, a major thing that makes WhatsApp worthwhile. Nobody can see what you're sending, whether it's Meta or outside parties. And so they say maybe they'll start to introduce that at some point. I think the big takeaway here, though, is that they're trying to get more utility out of WhatsApp beyond just chat. You're going to have, obviously, text chat, but you'll also have video, audio, things along those lines. And it will be a way for them to say, look, WhatsApp is a place where you can go and build kind of a community that people can follow. Now, it's not really too clear on whether or not you'll be able to talk back and forth with the whatever entity you're following. I don't think you would, because then that would just be a complete mess.
But how much of this is about the utility you pointed to? How much of it is about Facebook, Meta, trying to figure out if there's a way to monetize an app that has not sold ads, you know, despite pressure?
They spent, I forget, more than $1 billion on WhatsApp, and you know they haven't been able to make anything of it. The whole idea originally was, okay, how do we monetize this app? Encrypted chat was a thing. You know, WhatsApp was growing in popularity. They had Facebook Messenger, and they were like, well, we'll just scoop you up too, and this way we'll be able to, you know, we don't have to deal with that rivalry. And so now they have it. Now the idea is, well, how the hell do we make money off of it? And they haven't figured that out. This is perhaps one of the ways they do it. Maybe they start introducing from here commerce aspects where you can go in there and, you know, there's a store and you say, okay, well, this is what Nike's saying, and maybe I can pick up some, like, you know, new shoes or, you know, whatever have you. But it really is kind of part of their process of finding out what they can do with WhatsApp more than just having individual group chats.
And finding other sources of revenue potentially down the line. Dan Hallett, as always, thanks so much for that.
Thank you.
Past few months have shown a common trend in grocery stores. People are actually buying less. Food manufacturers like Kellogg, PepsiCo, and Nestle all reported sales growth in the first quarter of the year, but that growth had been fueled by higher prices, not consumer spending more or buying more. Sales of everything from eggs to bread and even cereal have actually been falling, which makes it an interesting time to invest in this space. Legendary rapper and entrepreneur Master P, he's not letting any fears of inflation keep him away from the business. The latest venture here, instead of serving up hit tracks, this time he's bringing something new to the table: Snoop cereal.
Delicious.
Getting everyone excited to taste the cereal that's coming up here. Teaming up with Snoop Dogg for the latest venture about to hit store shelves. Master P joining us here in studio, along with Brian Sazi. Master P, it's great to have you.
I'm glad to be here. Like you say, for me, growing up eating cereal, that was my breakfast choice.
I was going to say, so this is obviously far from your first business venture.
Yes.
You've been very, very successful in your career. Why cereal, and what's going to be the differentiating factor here?
Well, I grew up eating cereal. I grew up on WIC, and to be able to be in a partnership with Snoop, one of the most famous hip hop artists in the world. And we said, you know what, instead of just putting out music, we want to build a family brand. And so that's where Snoop cereal comes from. And we building that family brand. We're doing it together as brothers. And we said we come from hip hop, but why we can't change the game? Because we love cereal growing up. So we also the first black-owned cereal company. This has been going on for over 100 years that we've been consumers and never owners. So we're changing that game. Shout out to Post for believing in diversity that help us get these cereals on all these major grocery store shelves, from Walmart to Target to Ralph's to Albertsons to Amazon.com. And it's a blessing that we don't have, so when I talk about diversity, just adding diversity onto the grocery store. We know there's a lot of great companies and great brands, but here we are right there with them now.
I remember, it was about a year and a half ago, I remember talking to you when you were starting to get this off the ground. Why did it take so long to launch a deal with Post? This seems like, to me, a no-brainer, and I think a no-brainer to a lot of consumers out there. They're paying $8 a box for cereal, if not more. Yeah,
so what happened was we put out Snoop Loops at first, and we got into a copyright infringement, trademark infringement with Kellogg's. We had to stop that product. Snoop said, you know what, Pete, let's just give this product to the kids. We gave it to food banks. We lost millions of dollars, so I want people to realize that first go around for us was like practice, a learning experience. It's not losses, it's lessons. So we really had to learn the game, and once we figured it out and had national distribution, we know that it's time to have an African-American brand for the American people, for everybody, whites, blacks, Asian, Latinos. This is a cereal for everybody. And it's also a family brand name that we're building with Brodus Foods. So it's bigger than just cereal. Mama Snoop Oatmeal will be coming next. And so we're constantly growing. And so the partnership with Post, this has never happened before. So it's definitely time to change the game.
What is it like trying to get a brand like this off the ground against really established players? Any advice to entrepreneurs out there that now see this story, see these products in a Walmart, in a Target, in an Albertsons, and they want to replicate what you have done?
Well, we hope that we open those doors up for those guys where they're not afraid. I say just go for it. The opportunity is there's not a black or white thing. You have to really put the work in. But for us, it's not just getting into these stores, it's having great tasting product. We could put this product in a brown paper bag and it's gonna taste better than everything that's out there.
Boxes are cool though.
Yeah, the boxes are cool. Captain Ace is our character, and Captain Ace is all about education. We build curriculums for kids in school. We also made learning fun. We got music to go along with this and cartoons to go along with this so kids could have a fun breakfast.
And to that point, you're a big proponent, obviously, of financial literacy, getting our kids familiar with financial learning as early as possible. What has it done for your career, just in terms of your experience there, and how that's helped you evolve as an entrepreneur?
It helped me a lot, and I have a great partner with Snoop Dogg. I can't wait to go ring the bell with Brodus Foods. People could see that, you know. And even with Post, we want to be the part of there where that stock is constantly rising. We want to make their stock rise. We want to go on this journey together. And I feel like African Americans has been consumers for so long. When you look at these Fortune 500 company CEOs, we make 1/10 of 1%. So this is just motivation for me. This pushed me. I want to show people that change is here, growth. We're talking about in corporate America. So I feel like we could change this in corporate America to show other kids, to show Latinos, that blacks, that they could go out here and do this. And we're just a part of opening those doors, kicking those doors open for people that think that we're going against these major giant companies. But a lot of these companies started out their garage.
Do you think diversity efforts are still a buzzword? I talk to a lot of CEOs, and to me, I think they're just trying to check a box in many cases. But I look at what you're doing here at Post. They're taking a stand.
Nah, Post is taking a stand. Like, this have never happened. So, and that's what I love about this. This what my passion comes from, to make me want to go out there and show people that we got a company that's not just using buzzwords. They actually doing something about this. And so I think together we're going to make history. We're going to change the game. We're going to feed a bunch of people. For me and Snoop, our motto is the more we make, the more we give. And with the cereal, we're tackling homelessness and earlyhood child education. We're focusing on that, giving back to the inner city kids. But homelessness is so important for us. We want to be able to feed families, and this is the way we build economic empowerment.
SB, I want to switch gears here just a little bit and get your thoughts on what has certainly been a trending topic over the last several months, and that's AI and its influence across a number of industries. As a 5-time Grammy Award winner, how do you see AI revolutionizing? Do you see it revolutionizing the music industry, and how?
Yeah, I'm not afraid of it. I feel like we just got to get to that stage in life. We're going to need humans. Even though you see this stuff, humans are behind these things. So eventually the world is going to catch up with that technology, and we'll be where we need to be at. And we'll be able to do stuff more faster. I feel like it's going to change the game, but I also feel like you just got to know how to use it. I was telling somebody about this the other day. I say, well, AI for me, I could go to AI and try to get it to write something, but it's not going to be me. AI can't go, so it,
Not yet.
It won't
Can't do it like Master P.
That's
I'm
what
not
I'm
even trying
saying
right now. I'm not even
That's what I'm saying.
I know.
So no, but what I love about it, it'll definitely make some things go faster for us in the business world. So it got it good and it's bad. So we're getting there, but I feel like we're gonna get past that too. So.
Finding that balance and capitalizing on the strains there. Well, Master P, congratulations on Snoop cereal. Great. I'm excited to hopefully try some of those right after this. Right. Master P, thanks so much for joining us here in studio.
Thank you guys for having me.
All right, well, coming up, we are diving into a few stocks to buy and a few to say goodbye to. Stick around. We've got that for you after the break. Homebuyers looking at some relief from mortgage rates as affordability challenges weigh on prospective buyers. Here to break it all down, we have Yahoo Finance's Danny Romero. Danny, those new numbers out earlier today showing some signs of relief, but still high.
Yeah, don't expect a summer breeze. Rates are sitting above 6.5% for most of the spring season. And if we take a look at that 30-year fixed mortgage rate, it dipped to 6.71% from 6.79% last week. But this comes as inventory remains tight, the cost of homeownership is up, and rate-trapped homeowners aren't moving and they're not listing their homes. Demand for mortgage applications fell for 4 consecutive weeks. And if we take a look at some of the reasons for why people are not buying, Redfin says the average monthly payment is about $2,600. That's about 41% more than it was a year ago, so very costly. So you could say that this is a seller's market. They could have the upper hand right now, but that's really not moving the needle when it comes to inventory.
Well, I mean, let's talk about that inventory because, sure, mortgage rates are high. I mean, that's discouraging some buyers. There's still some buyers who are in the market saying, I still want to get a home, and yet I can't find the right one. And by the way, prices are high because there's so few.
Yes, and so inventory grew 0.7% last week. That's according to Alto's research, and they expect it to grow around 3% for the next 3 weeks. So that could mean fewer concessions for sellers. Not a great sign, but also fewer price cuts, which will also benefit a seller right now. So there is some positivity on the inventory side of things, especially that it is a major headwind right now.
Still have a ways to go there. All right, Danny Romero, great stuff. Thanks.
Well, how big can the bubble get before it bursts? AI is the biggest trend on Wall Street right now, and the hype is real. An AI-fueled rally sent NVIDIA shares up more than 150% so far this year. And the chipmaker is not the only company capitalizing on the trend. Palantir shares surged toward a 17-month high after launching an AI-powered data integration offering for manufacturers. And the rally's not showing any signs of stopping. But our next guest says, buyers beware, blaming the AI hype for driving stock prices to unreasonable levels. Let's bring in Lorene Gilbert, Wealthwise Financial CEO, to make her case. Lorene, your notes got a lot of us talking because we've heard over and over, NVIDIA is the big AI play. You've got that on your list of not great buys right now.
Well, and it's all about, when you buy a stock and how you buy a stock. But if you look at the forward PE of NVIDIA right now, trading at over 200 times, that it seems like an unreasonable valuation. And so there has to be a reason for it. There has to be something that would sustain that kind of valuation. And that would mean that we'd have to see some catalyst for a huge surge in sales or some efficiencies in profit margins. And we don't see the same story like we did with Tesla, which was able to accomplish both. So we just don't see that vision for the kind of valuation that we're seeing on those kinds of stocks. But it seems as if, though, the money that was invested in crypto has now all gone to AI. And so when I say buyer beware, there will be winners with AI. We just don't know who those winners are going to be yet.
Maureen, how do you go about trying to gauge who those winners will be down the line? Because I think so many investors are trying to figure out the next big thing. Yes, there is hype surrounding AI. So if it's not smart to buy NVIDIA, it's not smart to get into Palantir, I guess, what are you using as that base model in order to figure out who could potentially benefit?
Yeah, we're looking at the companies that we think could replace NVIDIA. So for instance, Microsoft, Google, those companies that could do it themselves and not rely upon another company for their architecture, and they could create it themselves. So we think that has a lot of more of a reasonable outlook, and as far as valuations, much more reasonable valuations as well.
So you're talking about companies that could own the full stack, right? I mean, there's so few, it would seem, and Microsoft is one. Some could point to Apple down the line. You can take a name like a Microsoft that has seen a lot of gains on the back of it, on the back of their success and their partnership with OpenAI. Is this a good time to get in on that name?
Well, we like it. We hold it. We do hold Microsoft, and we do think having those kinds of names, those are solid companies with solid balance sheets, and they're not going anywhere, and they're going to be at the forefront of AI as well. So that's why I'm saying I think companies like that would be the ones to look for.
Lauren, outside of technology, outside of the AI hype, you also point to another stock, or you do point to a stock that you think is going to benefit here, at least over the summer. You see a catalyst here for public storage, and that we don't talk about too often. Why do you like it?
Well, storage units are very profitable. So we're looking at a very profitable business model. We're looking at a 4% dividend that's 75% covered by operations. And when we look at their debt structure is reasonable, currently at 3.6% of their revenues. And even if it goes up to 5%, still a sustainable amount of debt load there. So we like the business. It's something that people continue to need, storage units. And if you can't go out and buy your own storage unit, looking at one that's publicly traded is another idea.
Lorene, when you look broadly at the markets right now, I mean, how are you thinking about where the investment should be? We've already talked about sort of the key themes that we have heard over and over. AI being one of them. Tech is one that is becoming increasingly a crowded trade. Are there some big bargains that you think investors are overlooking?
I do think when you look at opportunities, there's a number of opportunities. I think going down in capitalization is an opportunity, small and mid cap, looking more on the fixed income side, which is still a great opportunity. And frankly, we've seen the returns that we expected for the year already year to date. So taking that into account, the reality that we're most likely going into a recession would be a time to reconsider asset allocation, look at taking some gains off the table, look at increasing income as we see that as an opportunity, and ride out the rest of the year.
Lorene Gilbert, WealthWise Financial CEO. Some good tips there. Thank you so much for joining us.
Thank you.
Well, coming up, the closing bell on Wall Street, we check in on the markets at the close and break down some of the top stories of the day. Stay tuned.
we have is a merger between PGA Tour and Live Golf. The Saudi Public Investment Fund will be bankrolling a large portion of that new league to create sort of this big giant golf conglomerate. You can see golf stocks today have actually popped on this. Callaway golf stock up about 5% on this news. It seems like the market overall for golf stocks is bullish on this for the industry.
We need to see ultimately the reaction, how this plays out, but I'd call this, just as a huge golf fan, an absolute shocker.
It is hypocrisy. On the Live side, to your point, it was all about, well, we're offering competition here. There's only been one entity. And then on the PGA side, it was about the Saudis. It was about the 9/11 families. It was about, we would never go near that. At the end of the day, it's business.
To apply it to markets, we are seeing that there is a smaller and smaller handful of companies that are gobbling up everything.
I was as shocked as the rest of the world yesterday. I still have to say I don't fully understand either the process by which this happened or the premise of it, especially given that the tours were already under a bit of regulatory scrutiny for antitrust related issues. This seems to only potentially exacerbate that.
From a business perspective, this was kind of always how the story was going to end as long as Saudi Arabia stayed interested. You cannot compete with an entity with limitless resources and expect to come out on top if your measurement is by dollars and cents.
This was all about money. I don't think it ever was anything else. The PGA was put in a pretty bad spot. Maybe they put themselves in that bad spot. They couldn't afford the lawsuits. They couldn't afford the growing purses. And unfortunately, to some extent, they were in a position where they had very little option but to do this merger.
This PGA merger, it's designed not only to diversify Saudi Arabia's economic holdings, but also to help its image internationally. And that's also important to Saudi Arabia.
Let's do a check-in on the market. It's just about 2 minutes to go until the closing bell. We're looking at gains across the board. The Dow up at just shy of 200 points. S&P adding to the gains just below that 4,300 level that many on the street are closely watching. The Nasdaq adding just about 1% today. When you take a look at the sector action, technology, one of the outperformers in today's trading action. Consumer discretionary not too far behind. But Akiko, a lot of investors out there, traders, just questioning this hype, this outperformance that we have seen in technology since the start of the year. A lot of that driven by the excitement around AI and whether or not there's enough momentum to continue here to the upside.
Yeah, I feel like we've heard the word bubble a few times this week, but it really is about, how can you really differentiate between some of these names that have claimed to be sort of right at the foundation of AI. NVIDIA, one, obviously, that's gotten a lot of attention, the Microsofts, the Alphabets, but some of these other names that are sort of smaller players in AI, but that is going to continue. We have heard companies sort of push out the word to try and sort of get the hype going. So we're going to continue to watch that as well. Should point out some other sectors that we're watching today. Energy, another one. Oil, we did see it down about 2% here. Brent crude at $75 a barrel. Oil, WTI at 71. And this is kind of, on the back of the OPEC discussion that we continue to see. Sort of the $80 a barrel level is where OPEC would like it. But we're still seeing some downward pressure on that front. Overall on the day, though, some positive gains, as Shauna pointed out, across all three majors, with tech and consumer discretionaries leading the gains.
All right, well, that calls today's trading day. Again, all three of the major averages ending to the upside. The Dow up 167 points off the highs of the session. S&P up about 0.6%. The Nasdaq, the outperformer of the day, up just about 1%. Let's check in on some of the individual movers. And first up, casino stocks. Wynn Resorts and Las Vegas Sands closing the day lower. They were downgraded to hold from buy at Jefferies. The analyst there, David Katz, citing the new normal in casino stocks, saying that the recovery in the gambling hub has been, quote, approximately priced in at these current levels. We're seeing a bit of pressure today. Akiko, Las Vegas Sands has outperformed since the start of the year, up just about 20%, but I guess he's sees the recovery already priced into the stocks.
Yeah, I mean, a lot of this is really about their exposure to the Chinese market, specifically Macau, which is increasingly a bigger chunk of the revenue. And you know, to the point that you just made, Jeffrey's saying that a lot of that has already been baked in. There's been concern about how quickly that recovery has been picking up. Not as quickly, but we've heard over and over in the second half of the year, at least the China reopening story is likely to accelerate. Now, appears as though a lot of that has already been priced in, at least according to the analyst at Jefferies. And you see right there, a hold rating with a price target of $65 a share on Las Vegas Sands. Let's take a look at shares of Lucid. Closing the day lower today, down nearly 2% after the U.S. luxury electric vehicle maker's head of China operations said the company was preparing to enter the world's largest car market. According to a Reuters report, Lucid will sell imported cars in China, may even consider opening a production plant there. You know, the natural question I think that comes to mind is, okay, how big of a threat is this to Tesla? We should point out Lucid has a very, very high price tag. This is sort of the top tier of the EV market. But when you think about how many cars that were sold last year alone with Lucid, we're talking 4,300 vehicles in 2022. So we're still talking about a very small footprint, but it is interesting to see how they're trying to compete in the Chinese market, at least according to this report, and potentially produce cars there too.
Yeah, well, it can certainly be a huge growth opportunity here for Lucid, which has been struggling to really capitalize on some of their momentum here. When you take into account the fact that China is the largest market out there for cars, obviously entrance into this space would be good news here for investors. You got to question, though, demand right now. We know recovery in China has been slower than we had initially expected it to be. The numbers that Lucid is going for is still low, especially when you compare it to so many of the other EV makers, Tesla there, but also the Chinese EV makers as well. They're planning to produce more than just around 10,000 cars this year. So they got a long runway just in terms of when they make a larger footprint, larger impression within the EV space. But unlocking that potential in China would be very, very welcome news and huge opportunity here for Lucid.
I mean, premium price tag.
Very, very top of the line. 100,000.
All right, Carvana is getting a big boost today, closing the day well in the green after the company updated its financial outlook, now expecting total gross profit per unit above $6,000 in Q2 and adjusted EBITDA above $50 million. Let's bring in Yahoo Finance's Inez Ferre for more. Quite the stock move today, Inez.
Yeah, that's right. Well, Akiko, a record gain today for Carvana and a one-day gain, up 56% today after the company updated its outlook. Now, Carvana had said before that it would reach positive adjusted earnings in Q2 in 2023, but the outlook that was given today put in a figure on that would be above 50 million, as you just mentioned. And what this is showing really is that the company has been on a cost-cutting plan strategy. It laid off workers last year. Last year, the stock had gotten completely decimated over concerns of a bankruptcy, possible bankruptcy, over concerns of tightening credit. Now, that's the headline, right? But what happened was with the stock is you see a headline like this, the stock goes up and the short sellers get squeezed. So you saw a short squeeze on this stock because Carvana continues to be a heavily shorted stock, more than around 60% of the float. So look, this stock had entered the year at around $4 a share. It is up 425% year to date. We have seen these short squeezes before with this stock. When there's a positive headline, the short sellers that are betting that the stock will go down. When the stock goes up, they are forced to cover their positions, buy back those shares, and therefore that exacerbates the price to the upside. So that's certainly part of what we saw today with the stock.
Okay, and as for with the excitement, at least for today, around Carvana, thanks so much for that. Well, the excitement around AI has led to some huge gains for stocks like Microsoft and Nvidia. But Jefferies is looking ahead, long ahead here to the next decade, including which industries will be the hardest hit and which will benefit from artificial intelligence. Let's bring in senior analyst Brent Thill. Brent, you know, we've been talking so much about sort of the immediate impact since ChatGPT was released last fall. Let's look ahead to where the impact is and talk about, you know, which industries are likely to benefit the most.
Thanks for having me. The impact is everywhere. It's every industry. It's every potential field. whether you're a gas station or you're the CEO of a company. I mean, it's going to have an impact across the board. And right now, there's a lot of hype. And we believe that the hype turns to reality later in the year. A lot of the products that these companies are talking about will go live. And this will be a multi-year wave. It's not going to be, just a giant wave and hits and it's over. It's very analogous to what happened in the mid '90s when the internet was coming, or in the cloud movement, 2007, 2008. We think this move is very analogous, and we think it's actually more real because the type of returns. And so I think in the short term, it's going to be an enabler. It's not going to kill industries. It's going to be more of an enabler and help make all verticals more efficient. And when I say it's happening everywhere, I mean you can see it already happening. I mean, if you're a pilot, you can see what's happening with these systems and helping land a plane with Garmin Autopilot, Autoland. I'm not the Garmin analyst, but I've seen the demos of you lose a pilot, you can land the plane with a touch of a button. You're now seeing things with Microsoft and making developers more efficient. You're seeing it happen in insurance and in medical. It's really at the beginning, and it's really exciting. So I think, as many have said on Wall Street, we were lacking some excitement, and I think this is going to be a multi-year wave that is going to radically change every industry, and every technology company is talking about it. And I think there's a risk that it's a little hypey, and a lot of these companies are going through an economic pullback. They're seeing an economic headwind. So they're like, well, yeah, our current business isn't so good, but look at this AI thing. It's amazing. So, I'd say just be careful in the short term, but this will start to turn to revenue in the next couple of years. And as we put on this piece, these are, 10 plus year predictions of what the new world's going to look like. And some of it's exciting, some of it's really scary. But I think ultimately in the short term, most of the companies we're talking to they believe it's additive. It helps make their businesses better. And we're now going to have to go through an entire pricing and packaging and go-to-market change in how we sell this technology, because it's not going to be on seats. It's going to be on volume. It's going to be on usage. And so a lot of the tech industry is going to have a hard time making that conversion. And so there's going to be a little awkward teenage phase where we're going to go through in that process. So it's not going to be totally smooth, but it's going to be exciting, and we'll see what happens.
Brent, when you talk about the impact that this is going to potentially have here on pricing models, more explicitly, what exactly does that mean here for those companies that are adopting the new models? And then who do you expect to be the earliest adopters of AI?
So I think the earliest adopters of AI today are really software developers are really seeing huge impact. Like these aren't fabricated stories. These are real stories of. We were with the CEO of IXIC, and he said one of this companies that they own, Angie, which does the home repair, that the CTO was actually coding again. I'm sure he coded all along, but he probably lost, and again, this is my perception, not what he said, but the perception was like, when you're running a business, your developers are doing the work. Well, now the CTO is actually doing the development himself. The products are good enough where they help aid the development of the code. So there's numerous case studies from Microsoft with their GitHub product to GitLab reporting. Others are talking through this, that AI is helping these developers build code faster, cheaper, more efficient, more secure out of the gate. And that's having a huge impact.
Brent, so much of the conversation around AI concerns have been about, what it means for certain jobs, what will be eliminated, which sectors will be eliminated. Thought it was interesting that you highlighted advertising, that you think there's going to be a dramatic shift there. What are we going to see?
So you're in the 5 years from now, and it may not even be 5 years, you're on the Yahoo Finance page, and you're interested in XYZ stock, and it might be a tech stock, and it may know that you're interested in Tesla. The system then can automatically generate a ad. Maybe it's a Tesla ad. And again, I'm making this up. This isn't the reality today, but Tesla could generate an ad, understanding, okay, you're looking at the Tesla segment on your Yahoo page. It might be looking at the stock, but they want to generate an ad, and they can on the fly generate that ad tailored to you, understanding that you really like white cars, you don't like silver cars, and it builds this knowledge base. All of a sudden, the advertising system's generating this on the fly. Same thing in Meta. If you're on Instagram and you like golf, a TaylorMade or Titleist could self-generate an ad based on whatever you're looking at. And so Meta's been talking about this, that there's an incredible opportunity to generate advertising content without a human or a process or a system. It could generate on the fly. We think that could happen, and that you'll start to see that coming out very soon.
Brian, you covered. I was going to say, you cover a number of names in this space because I think a lot of investors want to know how to play it when it comes to Meta, Alphabet, Amazon, just some of those names that do have exposure to AI. What's your top pick for generative AI right now?
Microsoft, 100%. Microsoft's going to $400. We are huge bulls on the opportunity that they have with OpenAI. Remember, Nadella, Microsoft CEO, led this charge. He has the partnership with OpenAI. They saw the models building steam and getting better, and he was confident at the beginning of the year to make the move. All these products are going to come to market in the second half of 2023 into 24. It'll be a slow consumption, but over time, they're massive price lift. So my semi counterpart, Mark Lepasis, would say NVIDIA has been a long time NVIDIA bull. We like Microsoft. I think there's a whole host of companies. Adobe in content creation is going to benefit. Salesforce.com in sales and service, is going to make the sales system smarter because of AI. They have a big AI day in New York with the CEO, Mark Benioff, on Monday. We think this is going to be far reaching, but the single thing you have to look at is what are the companies that have the data and the users? Those are going to benefit. That's Google, Amazon, Meta. You look at Microsoft in the enterprise. You look at Adobe. One of our hidden AI gems is Snowflake. We think at their conference in June, they're going to unleash a fury of AI apps that make Snowflake consumable as the data cloud. All the enterprise content's in Snowflake. How do you get that data out? They're going to have more AI announcements coming at the end of this month in Las Vegas. There's a lot of different ways to play it, but our favorite clearly is in software is Microsoft, and semis is Mark Lepasis, my partner, would say NVIDIA.
No shortage of ways to play AI at this point. Brent Thill, great to have you, senior analyst at Jefferies. Thanks.
Thank you.
Coming up, returning to work and returning to the green. We're going around the horn and checking in on some of today's top stories. We'll be right back.
Curious about what's going on in the housing market and whether or not it's a good time to buy this home or another one? We've got you covered. We've got a jam-packed week filled with experts, including real estate agents from across the country. We'll also get a temperature check on the state of home building and whether or not it's a good time to stack up on those home builder stocks. We've heard from home builders that they're capitalizing on the housing shortage. We'll also tap into commercial real estate. Is it doom and gloom after all? And can't forget, we'll hear from the real estate queen herself, Barbara Corcoran. Tune into Yahoo Finance Live all week long.
It is time now to take a look at some of the top trending stories of the day. We've got Ali Cannell and Josh Schaefer around the table once again. And let's start with the great efforts Google is going to get staff back in their buildings. You'll recall that Google, since April of last year, has been trying to get this hybrid work going. We're talking about 3 days a week in the office. Now, there's a new memo that's been circulating around, a lot of reports that suggest the company is now updating their hybrid work policy by cracking down. So we're talking about confronting workers who aren't coming in, tracking office badges to see if they are attending, and then including the attendance and employees' performance reviews. Is that fair if you don't have workers who are coming back into the office?
I think if you're telling workers that you already approved to be remote, that they now have to come back when a lot of those workers have moved maybe to different cities and different states, that's not necessarily fair. However, I am a big proponent of the hybrid work model. I do think there's a benefit of being in the office and talking to fellow coworkers, seeing your manager. So to me, if that is a policy and you work for this company and you're making the big bucks and they want you to come into the office a few days a week, I don't think that is egregious. They're not demanding 5 days a week. 3 days a week, I think, is fair. However, if you fully approve people to be completely remote and now you're saying you have to come back, that's when I think it gets a little dicey.
I'm surprised that there's still so much pushback on these return to office plans, given the fact that the tech sector has been the most affected by layoffs so far this year. It certainly has outpaced any other sector by a wide margin. So you would think, given the scenario, that the employer has the upper hand. If you're not willing to go into the office, you might be next on the chopping block when it comes to the fact that if they were to be able, or if they did feel it necessary to announce another round of layoffs, further cuts.
Well, if you're worried about them tracking your bags, you're probably doing something wrong, right? It's that classic example. If you're worried about them tracking you, then you're probably not following the 3-day in policy, and you would think your boss would know anyway. Doesn't your manager know if you're in 3 days? If you're supposed to be in 3 days? It feels pretty cut and dry.
You know, what's interesting, though, it's a conversation I had in the office today about to what extent the employee should incentivize the return. I mean, if you've noticed, at least at the Yahoo office, when there's free food, we got a lot more people coming in.
Yeah.
Should that be an offering? I mean, we've heard companies doing that, but to what extent is it the onus on the company to be doing stuff like that?
I mean, that's a big question mark. And I think a lot of people, a lot of companies are really grappling with that right now. But I think I agree with Shauna that if you're in an industry where you're seeing mass layoffs, if there's a lot of disruption, it's probably a good idea to follow the company protocols. So that's just
so
my
if
take.
you're in the tech
But the perks
sector,
do
you
work.
can kind of take you're lucky to still have your job and we're keeping you part of the company, so we don't need to give you free lunch.
I mean, I still think free
that's
lunch
right.
should be. I mean,
There's
didn't Google already?
I was going to say,
have free
Google
lunch?
also has a heck of a lot of
things
perks.
going on in that
So
office.
if they're having trouble bringing people back to the office, given the number of perks that they have, at least in their New York City office, it really shows that maybe perks don't have the pull there that it does at Yahoo.
Yeah, maybe it's not like free, journalists who just go towards free food. Maybe it's not that easy with tech workers.
Maybe they're like, I'll make my own lunch. Well, if you're working from home, you probably can make your own lunch. You can probably watch a bit more TV, which brings me to my story today. Taking a closer look at that merger between Live Golf and the PGA. Obviously, a lot of question marks right now about what this entity is going to look like. Also, a lot of question marks on those network partnerships, right? With ABC, ESPN, NBC. How are they going to feel being so closely tied to Saudis? But another larger story that I was thinking of is the appeal of golf, because we've seen across the board that a lot of these viewership numbers have been on the decline. Obviously, the numbers for Live Golf are much worse compared to the PGA, but even viewership for that league has seen a decline, with the latest PGA Championship pulling in its lowest viewership number since 2008. I spoke with an expert earlier about this, and he was saying that golf is a hard sport to attract watchers to, right? Because it's very expensive to play. It's an elitist this sport, there's not a ton of diversity. It also has had trouble appealing to that younger demographic, that Gen Z that's used to those video games and other types of activities, maybe more action-driven sports like soccer. So it makes you wonder that as these networks pursue these sports, live sports contracts, if it's all sports or just certain sports that are the priority here.
I think my take on the live combination here and why it's probably a net good overall for the streamers would be what Live Golf was trying to do, right? Live Golf tried to be more bettable, I guess you could say, is sort of the word I'm going for there. They included teams, so you could sort of get used to teams. You could bet on teams. You could also bet on individuals. They let players wear shorts. They try to be a little bit more fun. They try to turn the event into a party. What part of that does PGA take and become a little bit more acceptable to the younger generation? I think is an interesting thing to watch here, because that's sort of what Live was going for. And it's the small things that people did like about Live Golf. Some people like the team atmosphere and like being able to bet on more than one thing. And then, of course, if you're a streamer and there's multiple things to bet on, there's more chance that I keep watching, right? If I can bet on more and more things. That's sort of how sports is developed.
I mean, I'm trying to think of all the sports that I watch, and I watch a lot of sports. I would not put golf at the top there, partly because I feel like it's not as fun to watch on TV.
But now you have more competition too, right? Part of the thing that golf was going through was they only had the 4 majors that everyone was playing in. Now you, in theory, could have everyone back on the same course again, so you have the world's best players all playing together again. That was a big narrative within golf. You also, we're all talking about golf a lot more than we have over the last year. And I think that
and
Netflix...
how much that translates into people actually going
I don't know, but the Netflix documentary I think is going to be popular again. Full Swing was rolling cameras the other day as the drama played out. Maybe they get that Netflix effect. I just think the fact that we're even talking about golf, that I think a lot of people find generally boring, it's not bad.
Well, as someone we have in our household golf playing a lot on the weekends on the TV, it is a little bit hard to watch unless you are very into golf. I'm not one of those people, I don't really get so into every single swing, which is what the avid golfer wants to watch. So I think that there is just this barrier to entry, just given the fact that, one, it's so expensive. 2, a lot of people don't have time to play 18 holes, let alone 9 holes. So you have this problem that has always existed with golf. Now enter Live, the Saudi exposure there. You'd have to think just in terms of the media rights, in terms of the brands that want exposure to the sport of golf, whether or not it's worth taking that risk, given the fact that the PGA Tour always wanted to distance itself, and usually did, from anything controversial, especially when it comes to political controversy. So now Saudi Arabia, obviously, as they have entered this space, it kind of changes the calculus a little bit in terms of the brands and the media rights.
I was just thinking about this when you were mentioning the Netflix show. I mean, sometimes it just takes one young personality to get people involved.
Well, that's
right?
the thing.
I mean, that's it. That's exactly it.
Big
so that's what they need.
They have Ricky Fowler. They could do a little bit more with
I think Ricky Fowler might not be the young personality anymore. But, I mean, maybe Will Zalatoris will come back.
He's a fun personality. Maybe not young enough, but fun.
Some people, we'll switch over to a player that people are definitely excited about, right? And we'll build up the hype from someone that always wears shorts. So Lionel Messi.
That's a good pivot. Good pivot.
The soccer player for Argentina saying that he's going to come to the MLS and play for Miami. That's spurring a reportedly $400 million offer from the Saudis actually to go over to their league. Now this deal is not yet official, but what's been interesting to watch is the overall hype we are seeing in MLS, which is of course now streamed on Apple TV Plus, so we've been sort of watching it through that lens as well. Interesting to look at ticket prices today. So Miami is scheduled to come to New York in August when they play the Red Bulls. Tickets are going to be $430 to get in when Miami comes, when Lionel Messi's here. If you were to go a week earlier,
$20.
$25. That's the Messi effect in 2 simple numbers of what he could do for MLS. I don't know. You don't know. He has to play well, right? Because that's sort of the thing here, is he needs to still be electrifying. But Messi has been that kind of soccer player that can have one moment, score a great goal, and get people in. So I do think they could have that kind
he's had an amazing career, but he is 35 years old. And that sort of raises the question about, why he took this package over the money that the Saudis threw, right? I mean, can we talk a bit about that? Some of the sweeteners that were put in, the brand partnerships potentially?
The Athletic's reporting that Apple's actually giving him some of the revenue that they're getting from the deal,
and then
which would be very
potential
interesting.
ownership after he retires.
Right. And there's also potential sweetener from Adidas to come over here too, which is interesting because Adidas really likes their MLS partnership. And I think Adidas also being person to lead their partnerships in the U.S. because the last one didn't go so well. So maybe Messi can help them out with becoming popular in the U.S. again.
I think Apple's interesting because I do think it's going to drive those subscriptions to Apple TV+. Apple, of course, signing that 10-year-long pact with the MLS, Major League Soccer. And they've really been leaning into the fact that they are the streamer where you want to watch soccer, whether it's real life or whether it's fictional with Ted Lasso. And even Ted Lasso has featured real-life soccer players. Messi's manager was featured on an episode. So they've sort of created this whole brand around soccer, and I certainly think it's going to help drive subscriptions.
I think it's going to help drive subscriptions, but I think to the degree how much is the big question here, because soccer has gone through many iterations. There was so much excitement when David Beckham came over, that fizzled out pretty quickly. There's obviously a lot of excitement surrounding Messi. Will we still be talking about it? Will we still see anything like those numbers that we just put up there, over $400 for a ticket? Probably not next year.
But I think it will help Apple when you think about what Messi is in Argentina. Think about the videos we were showing of Messi after they won that World Cup, how excited the people were. I mean, you look at Inter Miami's Instagram followers went from 1 million to 5 million,
wow,
basically overnight.
That is crazy.
If you can do that and you can draw massive mass appeal globally because people just want to watch Messi as long as he is playing, I think it might be bigger than we can fully understand here in the U.S. because, quite frankly, soccer just isn't that big.
Well,
it's not at that level.
At what point does MLS become a league that athletes come to at their prime, not at the end
that's a
of
larger
their
discussion that I don't know if they're ready for
Baby
that
steps,
yet.
Akiko, baby steps. All right, guys, we got to leave it there. But coming up next, the era of mega cap stocks is here. We're going to dive into the 8 stocks that are changing the game on the other side. The era of mega cap stocks is here with market leadership dominated by just 8 names. And as these stocks break away from the rest of the pack, we're certainly seeing a shift in market behavior. Here to join us now with more on that, whether or not it can continue, is Ed Yardeni, president of Yardeni Research. Ed, it's good to see you again. You're out with a recent note. First line in this is all the AI euphoria leading the stock market into another mother of all melt-ups. What do you think?
Well, I think we've already had a significant melt-up in the mega cap 8 since they bottomed in early January. We're up about 58% since that bottom. So that is quite a melt up in these stocks. And these are big cap names that usually don't move like that. Usually it's small cap names that have those kind of moves. But clearly investors feeling very, very comfortable with those stocks in an environment where there's still a lot of pessimism, still a lot of bearishness.
At what point do we start to see those gains be broadened out a bit more?
Well, I think the bears have been saying that because this market is so narrowly focused on just a few stocks, that it's still a bear market and that it's going to mean a sell-off. But I think the market could just as well broaden out. I think it may very well be broadening out. Let's not forget that the big run for some of these mega caps names really occurred with the banking crisis when people wanted to bail out of the banks. And they figured that if we're going to have a financial crisis, that can't be good for energy stocks. So they bailed out of energy stocks, but they still wanted to be in the market. And they figured out that the mega cap 8 stocks have a lot of cash flow, don't need to go to the banks, and have a lot of technology upside.
There's discussion about whether or not this new market narrative where we're seeing in terms of the leadership, if that's going to last, even if we do start to see more broader participation and broadening out of the market leaders. I guess how critical is the AI rally, the AI story to the continued success of so many of these larger tech names that have a heck of a lot of other things that are going into their businesses, and AI is only a very small part?
That's right, and it's just starting. There's a certain amount of hype. Nobody really knows the extent to which this really is going to be a huge technology, but everybody seems to figure out that the mega cap 8 stocks are going to be at the forefront of this technology and other technologies that are out there. It's not as though AI is the only technology that we have out there. We've got robotics, we've got automation, we've got nanotechnology. There's a tremendous amount of technologies that can be integrated to increase the productivity of the brain. In the past, technology or innovations increased the productivity of brawn, of the ability to lift things, to move things. The ability to kind of remember everything that's known in history and recall it through AI is just an awesome development. But I think it's the market is just trying to figure out who else is going to benefit. And the answer is everybody. I think you had a guest on before that basically said that. And the idea that I'm toying with is that we increasingly have to think about every company as a technology company. Because if you're not using technology to increase your productivity, your efficiency, and it's not just AI, but if you aren't doing that, you're going to be left behind.
You've been targeting 4,600 on the S&P 500 by the end of the year. That's still a lot of upside from where current levels are right now. How much of that is going to be driven by this tech rally we've been seeing? How much of it ultimately you think comes down to where the Fed moves?
Well, like the bears, I would feel more comfortable if the market broadened out. The bears are saying that it's not going to broaden out, and instead we're going to have a sell-off. I think it is going to broaden out, and I think we'd all feel better about the market if it broadens out. And I think one of the areas where it could broaden out would be in financials, the other energy, the ones that have been lagging behind here, the ones that have been viewed as potentially being vulnerable to a recessionary environment. I think as investors calm down about the recession scare, realize that we've been in a recession. It's just been a rolling recession affecting different industries at different times. And on balance, the economy continues to grow around 1% to 2%. And earnings probably bottomed in the second quarter right now. And I think the market is looking already past the here and now to 2024. And that looks pretty good.
So what does that mean then for the Fed? They're in a pretty tough spot just in terms of they're still in the fight against inflation, much higher than where the 2% target where they would like it to be. Lots of questions just about how much of that work has already been done, and we need more time in order to see it work its way through the system. Are you expecting another hike, and how much of that is priced in?
I'm not. I'm thinking that the Fed officials actually did a good job of telling us what they were going to do, what they wanted to do, what they wanted to achieve. And what they wanted to do, as they've been saying for months now, is they wanted to get the federal funds rate up to a restrictive level, restrictive enough to slow the economy down and bring inflation down. I think 5.25% on the Fed funds rate is proving to be restrictive enough. It seemed to have generated a mini banking crisis, and we don't want to go there again and have it broaden out. So I think it would be a mistake for the Fed to raise rates. And they have said that they expect to be keeping the Fed funds rate at a restrictive level. Markets have been thinking they're going to bring it down, but I think they may very well achieve what they wanted. Keep it at 5.25% through the end of the year, and then reassess things. But it all adds up, I think, to a continuation of economic growth. I think inflation is going to continue to moderate. And it's not just about tight monetary policy. It's also that the pandemic caused a lot of the inflation, and the shock and the aftershocks of the pandemic are wearing off.
Traders right now betting about a 70% chance that the Fed will keep rates steady at the meeting next week. Ed Yardeni, great to have you, president of Yardeni Research.
Thank you.
Well, mixed quarter for Campbell Soup. Sales of snacks like Goldfish surged 12% from a year ago, but consumption of its classic chicken noodle came out a little cold. Campbell's roughly 12% boost to prices during the quarter helped heat up sales, but volumes came under pressure due to the more cautious shoppers. Yahoo Finance's Brian Sazi had a chance to catch up with CEO Mark Klaus. Take a listen.
Well, I think, Brian, one of the things that you always try to do in a quarter like we were walking into in Q3 is to help people understand the context and the backdrop. And, kind of the story really for the quarter begins last year when our supply chain really started to recover. And if you think about the soup business and our meals and beverage business more broadly, we went a couple years coming out of a COVID into high demand periods where service and supply was a real challenge, not just for us, but for many in the industry. But I do think because of the desire and the need for us to really address some of those issues, we hit those very, very hard a year ago, and we were able to replenish and get retailers back in inventory in a major way. And that was about a 7-point help to us in the meals and beverage business. Soup, it was 10 points. And again, yesterday we got to lap that and explain that difference year over year. So I think the most important thing is to look at the in-market results, which certainly were a little bit slower as pricing as a contributor's come down a bit. But when I look under the hood at the parts of the soup business that we've talked about before as really being the bellwethers for the future, whether that's within our condensed business, our icons or cooking behavior, both of those continue to do very, very well. And if you look over the last 4 years, our icons have added almost 5 share points. And that gives us that strong foundation where our point of difference is strongest. And then the added value of the versatility of condensed with cooking has been a great build. And that's been even stronger with millennials, which was always a little bit of a question for condensed soup. Can we get younger consumers into the franchise? And then, Chunky's the next big bet for us. And that business, although a little bit more competitive pressure in the quarter as others were recovering on supply, latest 4 weeks, we're right back up to share growth. We're averaging about 8% growth on that business over 4 years. Complete transformation from what used to be kind of low price, traded on promotion, to a very, very compelling proposition with protein, convenience, and still good value. So those two are in great shape. And then the last one that really is important for the future is Pacific. That's our more premium, better for you soup brand. And that continued to grow in the quarter very strongly. We saw share gains there. It was actually the fastest growing ready to serve soup business in the quarter. And so I think for soup as a category, there's really no debate. We're in a much stronger position today than we were in the past. We did cycle some things we needed to get through, but as I look forward, I feel great about the contribution and the continued runway for our soup business.
There was some concern, Mark, out this morning, a lot of the analyst coverage about the rise of private labels in the soup business. Have you and your team tried some of these private labels? Are they making tastier stuff? Are the cans cooler? How would you explain them grabbing some share from a brand like yours?
I think, in a world of tough economic backdrop, and certainly as consumers are working to stretch their dollars the furthest, the temptation of a lower priced offering, and that's really what the dynamic is with private label. Is it's really about value. There are pressure in certain parts of our business that, we have to continue to make sure that the value, not price alone, but the equity, the value, we're doing a good job on. That's why, for example, in condensed, where we've seen some of that pressure from private label, it's not coming through on the parts of the business that really we have the most compelling point of difference. And so for those other parts, some of our flankers like Healthy Request or our more expensive condensed offerings, we've just got to make sure that we're providing a great proposition for consumers. But as far as like long-term migration into private label due to quality, I'm not concerned about that at all. We continue to be the winner in the categories we participate in, and I do think that in the fights that we've really made sure are most critical, we're continuing to win.
Soup, of course, Mark, is in the corporate name, Campbell's Soup, but the snacks business for your company has been on fire. Some of the best operating margins since you went out and bought that Snyder-Lance business a couple of years ago. Should investors be thinking more of Campbell's Soup as a snack-forward brand? And to that end, do you have to go out there and make some acquisitions to really lean into this growth?
Brett, it is perhaps an area where, if you ask me kind of what do I wonder or wish, look, we love soup. We love the soup business, our meals and beverage business. We've got a lot of confidence. And remember, this is a business that we have decided and committed to focus on in a different way than how the business was positioned 5 years ago. But half of our business is the snacks business now. And as you point out, it has literally been on fire. And to me, what's so powerful about this quarter, and perhaps in the detail and the bridging, this got lost a little bit in the story. But the reality is that this is probably the strongest proof point behind the thesis of why we acquired the Snyder's-Lance business. We saw a great set of brands that with our marketing and innovation expertise from Pepperidge Farm applied to it, we could drive growth. And you have seen that across all of the businesses in market, share, all of the above. We are growing these businesses in a steady state. And what made this quarter so impactful to the thesis is we've now begun that margin journey that we've been talking about. And as we've navigated through some tricky macroeconomic environments, we're now in a position where we're up 150 basis points on margin for the year. We've crossed 14% operating margin. And I really feel good about the momentum and our ability to sustain that progress going forward. And so with half of our business in this terrific on-trend leading snacks business with a self-help margin story that gives us fuel into the future, I really do think it's something that investors need to think about as they digest what's the potential and trajectory for our company.
And Mark, Campbell's headquarters in Camden, New Jersey, and right now I'm coming to you from New York City. We're both probably looking at orange skies that smell like smoke. Have you and your team taken a step back and thought about the next 25 years for Campbell's Soup and how climate change might impact your business and what changes you and your team have to make starting today?
Yeah, Brian, it's absolutely a conversation that is alive and well within the walls of Campbell. We really do believe that there is an opportunity to both be good and do good at the same time. And as we think about our ESG strategy more broadly, as it relates to the environment, as it relates to our energy use, our waste, all of the things that we know not only are going to help us be a better company, but are also going to protect our consumers and our businesses into the future. And so I can tell you that as a company, I do think that I inherited a great history and heritage of doing the right thing and being a great corporate citizen. But as the world demands more, we're going to demand more also. And we're continuing to move that bar up as we see our role in being able to contribute not just to the business, but also to the communities and the planet at large is a responsibility we take seriously. And a day like today, as you point out, it's a reminder to us that we've got work to do.
Campbell CEO Mark Klaus speaking with Yahoo Finance's Brian Sozzi there. Want to get to some breaking news in the auto space. Tesla's domination now growing. General Motors is following in the footsteps of rival Ford Motor and partnering with Tesla to use the company's charging network, gaining access to 12,000 chargers starting next year. Like Ford, General Motors will also begin installing a charging port used by Tesla known as NACS. This is set to start in 2025. And this really does, Shauna, in many ways, put everything, the infrastructure, particularly the chargers, in the hands of Tesla.
It certainly does, giving them that huge advantage there. We're seeing the reaction in Tesla shares after hours. GM stock was up just about 4%, I believe it still is right now, in extended trading. But you're right, it certainly does endorse Tesla's technology as the standard here, industry standard, going forward when it comes to those charging stations. Range anxiety is a real thing when it comes to the EV owners, people who are thinking about going out and buying an electric vehicle. I know from your experience, like you shared, Tesla's supercharging network is reliable, especially when you compare it to some of the alternatives out there in terms of some of their competitors with the other model there. So the fact that these drivers, EV drivers, are going to have access to even more stations, they will need to use an adapter before those new models are built in 2025. But that should, you would think, maybe help more people feel comfortable making that transition to an EV and not so concerned that they won't be able to find a charging station.
Yeah, and worth noting that the current industry standard is not Tesla's charger. It is what's called CCS. And if both of these companies are going to start installing those chargers into their cars in 2025, you have to wonder what the overall infrastructure is going to look like and whether, in fact, it is going to shift overall in the favor of Tesla. Because as much as GM, Ford, so many of these companies have tried to get the ball rolling here, and GM is one of those companies that's really built out, whether it's the batteries or the infrastructure, really making a play for the full stack. They just can't move quickly enough. With the reality right now is they're trying to sell those cars, the charging infrastructure just isn't in place.
Yeah, certainly a huge advantage. Will be interesting to see if any of others follow. But GM and Ford, great starting point there for Tesla.
Yeah, it's certainly a stock move on both ends there. Coming up, the pool of GOP presidential candidates for 2024 is growing, but who will bring the big ideas to the table? We've got more of that when Yahoo Finance returns. The pool of GOP presidential candidates for 2024 continues to grow, but the ideas coming to the surface seem to be less abundant. At least that's the take from our very own Rick Newman, who's here with us at the desk. Rick, how many are we at now, right now, in terms of candidates?
We got a dozen. We got an even dozen. There could probably be a couple more. You haven't heard of some of these people. Perry Johnson, I think most people have heard of him. He's a businessman from Michigan. Asa Hutchinson, former governor of Arkansas. Doug Burgum, the current governor of North Dakota. But they all think they can and deserve to be president, so they're giving it a shot.
And do they have different ideas?
Well, they're taking different approaches. The number one thing all these people, 11 of the 12, let's put it that way, have to do is they have to get Donald Trump out of the way. So some of them are doing this overtly. Chris Christie seems like the number one attack dog. He's going after Trump directly. And others are kind of doing it subtly. They're like Tim Scott, for example, the senator from South Carolina. He's like a more gentlemanly Donald Trump. He's Trumpy in policy, but he's genial and he's considered a nice guy. So he's not attacking Trump. He's just saying, I'm a sunnier version of Trump. So this is going to be a dogfight, until we get into, let's say, this time next year. Who knows what's going to happen to Trump? I mean, he's clearly the front runner, but he is already mired in legal problems, and this is just going to get worse. So there's this assumption that everybody says never underestimate Trump. But it's possible this really is going to be different in 2024, given all the legal problems he's going to have.
Yeah, you mentioned those legal problems. More specifically, when do you see that coming as an issue for him? Something that's going to come before the Republican nomination? Or are we talking general election?
It's a problem right away.
Yeah.
I mean, it's a problem now. And we're getting leaks and other types of information that there could soon be federal charges, federal indictment of Trump related to the classified documents at Mar-a-Lago, possible obstruction of justice. In Georgia, the prosecutor there in Fulton County is indicating she's likely to charge Trump with election fraud by the end of the summer. So Trump is going to probably be facing all these legal charges for a year or more going into the 2024 election. And we could also have trials. There's the one in New York that could get underway at some point early next year. Who knows how quickly this will take. I think at the federal level, it would probably be in the interest of prosecutors to do it quickly if they can, given how important it is for public purposes.
Well, and also don't want to be seen as being so political, right? That's going to be the spin either way.
Yeah, at least get a verdict, so voters can say he's guilty or he's not, and they can vote on that. But meanwhile, the Republican primary is already underway now that we have 12 candidates in, and we're even going to have some debates starting within a month or two.
Rick Newman, thanks so much for that.
Bye, guys.
Coming up, we get you caught up on some trending tickers moving after hours.
I just love the outro. Bye, guys. Let's take a look at two movers here after hours. DocuSign and Vail. Kicking off with DocuSign, that stock up just about 4% in extended trading. Strong results here from the company. They beat on earnings, double-digit revenue growth. Also, their guidance came in better than expected. Full year 2024 revenue guidance was raised there by DocuSign. Amex executive Anna Mars has also been added to the company's board. This is a stock that is up just about 5% so far since the start of the year. Over the last year, though, under significant amount of pressure, off just about 35%. So investors at least encouraged by the most recent result there that we got from DocuSign. Flipping over to Vail, a bit of a different story there. Shares off nearly 3% in extended trading. Profit falling here in its most recent quarter. Revenue was actually pretty decent, but Vail was hurt by the fact that some of its resorts, especially in the Mid-Atlantic region and the Midwest, had to close early because of the climate here, warmer temperatures forcing them to close some of their ski resorts here. Year to date, the stock up just about 8% over the last year. We're looking at the stock essentially flat. So Vail Resorts off just about 3% in extended trading.
Well, let's get to the three things you need to know at the end of your day. A blanket of toxic air engulfing northeast states, likely to last until next week as the impact of Canadian wildfires heads south. Washington, D.C. is currently under a very unhealthy air quality alert. President Joe Biden saying the U.S. will respond promptly to any Canadian request for more firefighters and air tankers. New York City airports, including LaGuardia and Newark, are facing ground delays for a second day because of low visibility. And the delays could create a ripple effect on U.S. flights as much air traffic flows through New York and the Northeast.
GameStop shares plunging after the former meme stock darling fired CEO Matt Furlong and elevated Ryan Cohen to executive chairman. Cohen, who had been anointed by the Reddit community as, quote, the meme stock king, originally founded a pet food retailer Chewy before joining the board of GameStop in early 2021. He hired Furlong in a bid to boost sales at the embattled video game retailer, with latest results, though, showing a revenue drop and narrowing of losses in the fiscal first quarter. In 2020, a mixture of short seller panic and retail investor fervor drove shares up astronomically amid the COVID era's meme stock mania.
And Tesla continuing to dominate EV infrastructure. General Motors now following in the footsteps of rival Ford Motors and partnering with Tesla to use the car maker's charging network, gaining access to 12,000 chargers. Now, like Ford, General Motors will also begin installing a charging port used by Tesla known as NACS. This is set to start in 2025.
All right, well, that'll do it for us today on Yahoo Finance Live. We'll see you right back here tomorrow afternoon, 3 p.m. Eastern Time for all your coverage leading up to and after the closing bell. We'll see you then.